Good morning. Welcome, everyone, and thank you for joining us today at our Fall Tax Forum. My name is Farhad Aghdami. I'm a partner in the tax section as well as the private client and fiduciary services practice here at Williams Mullen. I'm joined today by my colleagues Conrad, Garcia, and Adam Farnsworth, and we're all based out of the Richmond office. Before we begin our program, I have a few housekeeping items. First, if at any point during the presentation you may submit questions by using the Q&A button at the bottom of your screen. We will address questions as the time permits, and if we don't get to your particular question during the webinar, we'll follow up with you. Also, if you're having any audio or technical problems, please use that same Q&A button and we'll help to resolve that. This program has been approved for 1 credit hour of CPE credit, and our application for 1 hour of CFP credit is pending. This afternoon, you'll receive an email with a certificate of attendance for CPE, and we'll send a separate email when our CFP credit has been approved. Here's a quick look at today's agenda. I'll be kicking us off with some strategies for wealth transfer tax planning and looking at what might be coming down legislatively. From there, Adam and Conrad will speak to the proposed tax legislation affecting businesses and individuals and accelerating gain. With that, let's get started. If we can go to the next slide. So I think there were a lot of other updates I was going to talk about, but on September 13th, the House Ways and Means Committee released a draft of the tax provisions included in the reconciliation bill. And there are a number of provisions that affect clients in the wealth transfer tax planning space. So I'm going to spend most of my time this morning talking about those provisions and what they mean and what they could mean for our clients and things that may want to be thinking about between now and the end of the year. From a big picture perspective, there is a termination of the increase in the unified credit. You may recall it was going to increase. It increased in 2018, and they're going to reduce that. There will be an increase in the reduction of value of farm use property. There are 2 sets of rules involving grantor trusts, and that's probably the biggest area of focus. And then there's also some new rules on valuation for non-business assets. So going to the next slide, the first thing is the bill proposes a reduction in the unified credit. And as many of you all may recall that in 2012, that tax act increased the estate and gift tax credit to $5 million per person, which was adjusted for inflation. The 2017 Tax Act temporarily increased the exemption amount from $5 million to $10 million per person as adjusted for inflation. And this year, the inflation adjusted number is $11.7 million. That provision was included in a tax reconciliation bill also, and so it was temporary. And it sunset, as drafted, it would sunset on December 31st, 2025, and reduce to the $5 million number in 2026. The House Ways and Means bill accelerates that reduction and brings that forward. So it will drop to essentially the $5 million for gifts made or for estates of decedents dying after December 31st, 2021. The inflation adjusted number for 2022 is estimated to be around $6 million per person. If we go to the next slide, so clearly the planning opportunity is to consider making some gifts this year, because clients who have $11.7 million this year of exemption will only have approximately $6 million of exemption next year, and they're effectively losing $5.7 million of exemption starting next year. The issue with, I think the planning idea would be to make taxable gifts that would use up the exemption. The problem is there is an ordering issue in terms of how the exemption is used by taxpayers and how, when Congress takes away the exemption, how it's taken away. The way I sort of think about it is the exemption is sort of one of those Hershey bars with the little squares on it. And the way and it's sort of sitting vertically, sort of on a sort of portrait mode, if you were to be printing it. And the way you use your exemption is really you start eating away at it from the bottom up. And as you make gifts, you move up and you eat more of those little squares and use more of the exemption. When Congress takes away or when they reduce the exemption, they take it from the top down. So they take the top half off and you're stuck with the bottom half. And so in order to really fully utilize the exemption that's going to be lost next year or reduced next year, client really has to kind of eat their way all the way up to the top. And they really have to make an $11.7 million gift in order to fully utilize that this year. If a client says, well, I'm going to lose $5.7 million next year, so I'm going to make a $5.7 million gift this year. Really, if the exemption next year is $600,000, they're only going to have $300,000 left. So it's I've had a number of conversations with clients who would say, well, I'd be willing to give away $5 million so I can preserve what's going to be lost, and say, well, that doesn't move the needle. Because you're not going to be able to use what's being lost. And so in order to really fully utilize it, you've got to make the full $11.7 million gift. And not all clients are willing to do that. If we go to the next slide, there are a number of gifts that clients can consider, and types of gifts that they could consider making between now and the end of the year. But there are certainly some risks that we'll talk about. But I mean, I think first, just making outright gifts to children or descendants is a terrific idea. They could also consider making gifts to generation skipping or dynasty trusts for the benefit of their children and descendants. They could consider making gifts to what's called a spousal lifetime access trust, which is really a trust of which the spouse and the children and descendants are considered beneficiaries. There are certain types of trusts called self-settled spendthrift trusts where the client can actually be included as a beneficiary. That has to be done under state law that permits it. Virginia does have such a statute. You could create other things that maybe use up gift exemption, like a personal residence trust, although we'll talk about some of the grantor trust issues that come up in a minute. And then we've had a lot of clients who have lent money to trust or sold assets to trust, and they may want to think about forgiving promissory notes as a way to really, do a quick and easy gift. But as I said, there are some caveats, and that's because there will also be some changes to the grantor trust rules. If we go to the next slide, I want to talk first about some valuation issues that are also tied to some of the valuation. So even though they're dropping the estate and gift tax exemption amount from $11.7 million down to essentially $6 million next year, there is a desire to be able to protect family farms and family businesses. And so they are including a provision, an amendment to Section 2032A, dealing with the valuation of property that's used for a farming business or used in a trade or business. And the idea under Section 2032A is that rather than valuing the property at its highest and best use, you can value it at its farming value. And, the thing I think about it, if you folks who lived in Richmond have lived in Richmond for a long time, there was a very, pretty farm across from the Short Pump shopping center. And I always thought that's like the perfect asset to qualify for Section 2032A, because you've got this thriving shopping center right across the street from this farm. And that's the idea, to be able to value that property not at its highest and best use, which might be a shopping center, but really value it for farming purposes. That provision, 2032A, really only allows you to reduce the value by a fairly small amount. The number is $750,000 and is adjusted for inflation. It's I think 1.19 million this year. The bill will increase that $750,000 number to actually $11.7 million. And that number will be adjusted for inflation going forward. So this is sort of a provision to rebut the argument that the estate tax is hurting family farms and businesses, and so they're providing for this benefit. If we go to the next slide, I want to talk about some of the new grantor trust provisions. The first is Code Section 2901, and that really addresses the estate and gift tax consequences of grantor trusts. And just by way of background, a grantor trust is a trust where the person who, in most cases, creates the trust is considered the owner of the income for income tax purposes. What's sometimes referred to as a defective grantor trust is a trust where it has a bifurcated tax treatment, where the grantor is considered the owner of the trust for income tax purposes, but the asset is excluded from the grantor's estate for estate tax purposes. The House Ways and Means bill comes out very hard against grantor trusts, and really radically changes a lot of the rules dealing with grantor trusts. What they now provide is that assets that are held in a grantor trust will be included in the grantor's estate at death. And so that bifurcated treatment where you have a portion subject to income taxation but excluded from the estate, that will no longer occur. Excuse me. The second provision is that any distribution from the grantor trust, other than to the grantor or the grantor spouse, will be treated as a gift. And so if you've created a trust and you make a distribution to a beneficiary, that will be treated as a gift by the grantor. And then third, if the grantor trust status of the trust ceases during the grantor's lifetime, all assets that are attributable to the grantor trust portion of the trust will be treated as having been gifted to the trust by the grantor. So now you've got a new gift to the trust. And so this really kind of creates a death knell for planning with grantor trusts going forward. The effective date provisions of this statute, it says that it applies for trusts created after the date of enactment, and it also applies to contributions that are made to existing trusts, but the contributions are made after the date of enactment. And so existing trusts arguably should be grandfathered and should be protected. And then the question is any trusts going forward are going to be subject to these new rules. If we can go to the next slide, the problems that we see in terms of this provision is it's really hard to determine when a trust is a grantor trust. We'll have clients who will come in and with a stack of documents that have been prepared, and they'll say, okay, these are the grantor trusts and these are not the non-grantor trusts. And very often we're like, nope, that's not right. These trusts, some of these trusts that you think are non-grantor trusts are actually grantor trusts. There are a number of powers that cause a trust to be a grantor trust. The power to use income, trust income to pay life insurance premiums causes the trust to be a grantor trust. So most irrevocable life insurance trusts could be considered grantor trust. And if you make, let's say you have an irrevocable life insurance trust and you make a contribution to that trust to pay the annual premium, well, under that code section of 2901, that portion is going to be included in your estate. You can have a trust where if the spouse is considered is a trustee, there's a spousal unity rule that says all powers that are held by the spouse are deemed to be held by the grantor. And so that could cause grantor trust status. If, for example, I name my wife as a trustee, it's a grantor trust. But if I name Conrad as a trustee, it may cease to be a grantor trust. And so turning off grantor trust status, people just aren't aware when that happens. There's also an issue of what happens when you have a trust like a qualified personal residence trust, where a person contributes, let's say, their residence to the trust. They retain the right to live in that property for a term of years, and then at the expiration of the term, the property is distributed to the client's children. Or you create a GRAT, where you contribute assets to a trust, retain an annuity, but then at the expiration of the term, the assets go out to the client's children. Or the same with the charitable lead annuity trust. These are all QPERTs, GRATs, and often charitable lead trusts are considered grantor trusts. And so there's a concern that if when that trust terminates and distributes the assets out, then during the lifetime of the grantor, it ceases to be a grantor trust. And the concern is now under Section 2901, you're captured under that provision, and you've got these adverse tax consequences. A qualified subchapter S trust is deemed to be a code section 678 trust, a beneficiary grantor trust. I said early on that typically it's a trust as to the grantor, but in the case of a qualified subchapter S trust, it's really considered a grantor trust as to the beneficiary. And then you also have the issue if a person creates an inter vivos QTIP trust. So these are issues that we see with the statute. I think, I think practitioners are communicating with Congress, and obviously folks are weighing in on what they see. I know the insurance industry has had conversations about this life insurance provision. But these are all concerns, and certainly create concerns about planning today. Creating new grats and doing that type of planning gives me some pause. If you can go to the next slide. There's also a new code section, 1062, and this is really intended to deal with situations where a grantor transacts or enters into a sale transaction with a grantor trust. And really, what this provision states is that sales between a grantor and a grantor trust will not be disregarded. So Revenue Ruling 8513 says is that when a grantor transacts with a grantor trust, that transaction is disregarded because they're transacting with themselves for income tax purposes. This provision would effectively treat that as a taxable exchange. And so this effectively allows sales to grantor trust for a promissory note because you have a taxable exchange, installment payments and whatnot. It also makes it difficult to transfer what I call negative basis assets like partnership interests with negative capital counts or debt in excess of basis to a grantor trust, because you would be triggering gain upon that transfer. This provision is effective for trusts created after the date of enactment, and then it also applies to contributions or transactions made to existing trusts after the date of enactment. One of the powers that's often included in a grantor trust is the power to substitute assets. So essentially, the grantor can reach into the trust, pull assets out, and replace them with assets of equivalent value. We've heard that there may be a modification to the effective date rules to provide that this contribution would capture that type of substitution, and so you could not do a substitution after the effective date of the enactment. And so that's awfully troubling. I think the concern, I think the policy concern is that people will create these grantor trusts with and have highly appreciated assets inside the trust, and then shortly before death, they'll swap assets out, the low basis assets out, replace them with high basis assets, and the low basis assets are included in their estate and get a step up in basis at death. And so that's the provision where I think they're trying to address. If we go to the next slide, there's also some new valuation rules that come into play to deal with valuation of closely held business interests. And really the idea is what they're trying to do is look at situations where people are generating valuation discounts where there may not necessarily be merited. And so if I put $10 million of marketable securities in a family limited partnership and I gift away limited partnership interests, those interests are going to be valued really at net asset value to $10 million and not going to get the 30% discount that makes them worth $7 million instead of $10 million. The statute provides that a non-business asset is really any passive asset that's held for the production or collection of income and is not used in the active conduct of a trade or business. So it'll include things like marketable securities and things like that. If you have, let's say, an operating business that is, actively conducted, then a valuation discount, should still apply. But if that business, for example, has a lot of really non-business assets, so it's accumulated a lot of cash, or it's got other assets like marketable securities, things like that are really non-operating assets that are inside the business, then you would really you'd sort of bifurcate the valuation, and you'd value the non-business assets really at net asset value, and the operating business as you would normally do that. They will provide an exception for working capital, so they understand that businesses will need to have some level of working capital, and this provision will be applicable to transfers after the date of enactment. And so there's still some time maybe to do some planning in this regard. If we go to the next slide. So what I would say is, at this point, there is, I think, a window of time to do some additional planning between now and the date of enactment, or in the case of the reduction of the estate and gift tax exemption amount, the end of the year. My sense is that this bill will likely change several times. What we have seen is the House Ways and Means draft, I read, I think today, that the House Rules Committee is going to be making some markups today, and so we will likely see some additional revisions. And typically, there will be a Senate version of the bill, and we have not seen what the Senate is going to be producing, and whether or not there will be any differences there. What I would also say is to be really careful with the effective date provisions, and if there's going to be any transition relief, but also just thinking about the timing of these transactions. With the grantor trust rules, those are really effective at this point on the date of enactment, whereas the increase of the or the drop in the estate and gift tax exemption will be really at the end of the calendar year. We have some clients who, we've walked them through these grantor trust rules and the new rules, and they say, well, can we create a non-grantor trust? And we said, well, sure, we can, you can certainly create a non-grantor trust. We can design the trust that will qualify that way. And the question is, well, can we create a slat that is a non-grantor trust? And that is possible. You could create a spousal lifetime access non-grantor trust. I'm not sure if the acronym is going to be SLANT or SLANG. I've seen some people use SLANT, and so that may be the new phrase, but it is possible to do that. It requires a little bit, fairly careful drafting to make sure that you're not, running afoul of the grantor trust rules. The hardest part is having the spouse be a beneficiary, and so the spouse's interest needs to be, or distributions to the spouse need to be approved by an adverse party, which could be another beneficiary like a child, and you typically need to have a independent trustee serving, but it can be done, and we're actually doing that for several clients. The nice thing about those non-spouse, I'll call them slants, is because that provision is not really effective. It's not being addressed by the grantor trust rules. The planning for that can be done, all the way up until the end of the year, because you're really just trying to make the gift to the trust and have it just be coming in under the wire and take advantage of the larger exemption amount. Let's go to the next slide. So that's really the summary that I was going to provide on the new legislation. There was one piece of news that came out actually yesterday, and that is the IRS released final regulations authorizing a user fee for the issuance of estate tax closing letters. So, previously, I'd say in sort of the good old days, you'd file your estate tax return, and probably, in the case of a non-taxable estate, you'd get a closing letter with probably 6 to 8 months. And in the case of a taxable estate where you're actually paying estate tax, those are typically audited, and you'd get your closing letter at the end of the audit. In the last couple of years, that process has really slowed down, where really they no longer issue closing letters. That's a matter of course. You can request one. You have to fax in a request. You can also go on to the IRS website and obtain a transcript for the taxpayer. And if you find the code 421, that will confirm the closing of the IRS examination. And closing letters are important because that obviously signals that that the estate is closed. Very often, commissioners of accounts who are reviewing estate accountings will want proof that, and they'll request a copy of the closing letter. So it is important to be able to get those. And because this process has gotten so bogged down, thankfully the IRS is now hopefully going to be able to add some additional resources. Obviously, the $67 user fee is not terribly significant, and hopefully it will allow them to add resources and provide better administration of this process going forward. So at this point, I'm going to turn things over to Conrad and Adam, and they're going to tell us about proposed tax legislation really in the business and individual tax arena. So Conrad and Adam.
Thanks, Farhad. Good morning to everyone. Adam, we can go to the next slide. Folks, what I'm going to point out here is some of the proposed increases and then some requests we're getting about should we accelerate gain in looking at the M&A world today. I think for purposes of this slide, one thing that we did see is the capital gain rate is going to go from 20 to 25, which is better than the 39.6% rate. However, the effective date right now in the Ways and Means Committee for the capital gains rate is September 13th, 2021. If you have a binding contract as of that date, you would get the old rates. Anything that closes going forward, we have already had a couple requests of what is a binding contract. because there's no legislation and it just says the words, we've been looking, kind of like the accelerated depreciation rules. I did find out that, binding contract is used like 13 times in the whole Internal Revenue Code. The other two that are coming up is if you make more than 5 million, these two are effective next year, is the 3% excise tax, modified adjusted gross income. I'll talk a little bit about the 3.8 next slide. Corporate rates, if you have more than $5 million of net income, they go up to 26.5%, and the top rate goes from 37 to 39.6. Next slide, please. There was a lot of talk about carried interest reform. I think you're looking at 5 years, and I believe in looking at the legislation, it really is going after hedge funds and some private equity. I thought real estate was really left alone in this, but there is an extending of the holding period. But you have all the rules and regs that came out this year, so you got to think of the increased holding period and some of the change to statute. I think one of the bigger changes that we've seen is the net investment income tax. The proposal is if you have an SCorp or a partnership and you have more than $400,000, it used to be if you actively participated, you could exempt yourself from the 3.8. This is not doing that now. So this is basically another 3.8 increase. So what we've been talking about in the M&A world, if these proposals go through, is you already got a 5% increase to the capital gains rate. And if you don't close this year, you're looking at basically another 6.8 if you're in a flow through entity, because you have the 3A, and if your gains more than $5 million. Let's go to the next slide, please. I think the other thing that caught some people off guard is you heard a lot about 1202 stock, and a lot of people were making choice of entity discussions on the, getting the exemption at 0% or 10 million. What this has come in is basically said, if you have more than 400,000, we're going to tax 50% of that gain. And what happens under 1202, it's actually like at ordinary rate. So when you do the effective rate of all this, you're basically coming out at 20%. Got to really do the math, but it's just something to be aware of. And 1202 treatment is not elective. It's actually a statutory provision. You see, they want to cap the deduction for 199A, I think at 400,000. And then if you have an excess business loss, they want to either permanently disallow it or carry forward. I think one of the things in looking at all this proposed legislation is one thing that we see is even if it's changes, rates are going to go up. That's what you're seeing in there. So the question that we're getting, and Adam's going to talk about next, is what are we doing to try to have folks think about the gains, knowing that we're not financial planners, but providing options. And with that, Adam, go ahead.
Thanks, Conrad. Appreciate it. Just like Conrad said, we've been getting a lot of questions from clients who own businesses or, want to look into ways of accelerating their gain to try and recognize, whatever gains or trap gains or built-in gains they have in their equity interests in companies that they own, try and recognize that now as opposed to next year. Now that remember that the capital gains rates, those might be effective as of September 13th if you don't have a binding contract, in place before then. So, some of what we're going to discuss here are certainly opportunities for planning, but at the same time, they are, it may be that if the effective dates for some of these capital gains increases is September 13th, then, we need to really be careful about, finalizing these transactions in this year. Kind of to echo what Farhad mentioned with respect to, the planning with the grantor trust, just be careful about timing. And that's what we're trying to get across to clients as we navigate this proposed legislation. Some of the things that Conrad and I are looking into for clients in order to look into accelerating gain, just some from the most basic standpoint, just electing out of installment method. That's one of the easiest things that a lot of people can do. And there's a way that if you, don't elect out in the year of sale, that you could maybe, recognize the additional or what's remaining on that installment method by, leveraging or using that promissory note or whatever it is as collateral for another debt or we're also looking at, in a partnership context, dealing with negative capital accounts. This is something that we see often, and something that we're able to, take advantage of. In the SCorp context, we're looking at, simply converting the SCorp to a partnership and distributions in excess of basis. So this was kind of some of the things that Farhad was saying you need to be careful with on grantor trust planning, is some of the stuff that Conrad and I are trying to find our way through here in terms of accelerating gain for people. We need to be careful, and Conrad and I are very, we're adamant about this. This is, there's a lot of foot faults here that we need to be careful of when you're advising clients. For example, we've got a lot of rules that apply in SCorp partnership context when you're talking about related party transactions, such as 1239, 707B. What that would do, what these sections do essentially is turn whatever capital gain treatment you might have into ordinary income. And that would basically blow up, the transaction. It would nullify whatever benefit you might have by trying to accelerate your gain this year and take advantage of lower capital gains rates. There's some authority out there from the IRS. That's in Revenue Ruling 72-172. And we'll I have a couple of slides on this. We can talk about it later on, but this is just stuff you got to keep in mind. First things first, let's talk about installment sales. Obviously, an installment sale is where you have a sale of property and you receive one payment in the tax year after the date of which the sale occurs. So in our context here, we're going to look at an example. Conrad sells an equity interest in 2021 to a third party. He receives cash and a promissory note. We see this all the time in the transactions that we deal with. Let's say that promissory note is payable in full in 5 years. On one of the ways this is an election, so one of the ways that Conrad can recognize his gain all in 2021 is he just, on his timely filed tax return for this year, he reports the entire gain as income in 2021. What does that do? It basically just makes it so that all of his gain for the whole 5 years is going to be recognized here in year one. This is another thing that you have to keep in mind when we're talking about accelerating gain, because oftentimes when you accelerate gain, you don't have the liquidity to pay for the taxes on that gain. So one of the tax considerations that we need to be mindful of when we advise clients is that, that the client might have to come out of pocket to pay the tax on that gain. And they may not have they have to look for other sources in order to be able to pay that. So just be mindful of that when you're advising somebody to elect out of the installment method, that they're going to have to pay that tax. And if they don't have the money to pay it, then that's not something that you want to advise them to do. Obviously, the installment method, you can't use it to report, or to defer gain on inventory or sales of inventory and sales of stocks. You can't use it to report losses. So obviously, just be mindful of kind of the position of your client as a taxpayer in what that installment sale or installment method covers. This last point I think is pretty interesting. Obviously, if let's say Conrad did not report the entire gain in 2021, one of the ways that you can sort of accelerate that gain is to dispose of the installment note. So if you have somebody who sold a business last year, they're under, they're in the installment method and they want to recognize or accelerate the gain this year, they may consider looking into disposing of that installment note, selling it, pledging it as collateral for another debt, or canceling it, or giving it to a family or charity. And what that does is it basically just accelerates the gain, whatever's remaining on that gain. That's just in the installment sale treatment, and we're looking here now at the partnership context. So we're going to look at dealing with negative capital accounts, way to trigger gain, when you have negative capital accounts. Farhad alluded to this in his grantor trust context. In our situation, we're going to look at, here's Conrad. Conrad owns 100% of CG Real Estate LLC. This is a disregarded entity at this point. This is a common transaction that we can, in order to have some negative capital account that we can then utilize to trigger gain. So Conrad forms a holding company. It's a 100% owned LLC, and he contributes 98% of his real estate company to this holding company. And what he gets out of it is 100% of the membership interests in the holding company. And you'll see in a minute why we're only given 98%. All right. So this is the resulting structure. Conrad owns indirectly 100% of the real estate entity and 100% directly the holding entity. So one of the ways you can create negative capital accounts, we see this all the time. So you go out to a third-party lender, you obtain a loan in the real estate company. And, you know, basically you lever up here at this point, and the loan or the amount of the loan should approximate the aggregate fair market value of Conrad's interest in this entity. Okay. So then what happens? Then the real estate company distributes the loan proceeds up the chain to holdings and to Conrad individually. And then holdings then takes its pro rata portion and distributes it out to Conrad. And what this does is the distribution of the loan proceeds, typically in most contexts, is going to cause Conrad's capital account and the holdings company to go negative. And we're going to take advantage of that negative capital account in the next step. So what you do now is we make a check the box election and elect to be taxed as an S corporation. So holdings goes from a 100% a disregarded entity to now a regarded entity, an S corporation. And what that does, upon that SCorp election, Conrad's deemed to contribute all of his assets and liabilities and holdings to a newly created S corporation in exchange for stock. And that's followed by a distribution of the stock to him in complete liquidation of his LLC. So that liquidation now is the part that we focus on. This is how you trigger gain. It's typically that liquidation is considered tax-free, except to the extent that Conrad's capital account is negative, which, because of the leverage distribution, that's exactly what we have. So when he converts to an S corporation, that negative capital account now triggers the gain. And that gain that's recognized should be capital, except to the extent it's recharacterized under the recapture rules and then under 1239, which we're going to talk about. Here's an S corporation context. So we see that a lot, leverage distributions in the partnership context, especially dealing with real estate. Here's a couple of examples of what you can do to trigger gain in the S corporation context. First and foremost, it might be as simple as just converting your S corporation to a partnership. And so in this context, we have Conrad and Adam, who own 50-50 of an S corporation, and they enter into a state law conversion. And they make a protective check the box election to be taxed as a partnership. So you convert the S corp to an LLC, and then you're taxed as a partnership at that point. And what that does is the S corporation is treated as distributing all of its assets and liabilities to us, the shareholders, Conrad and Adam. And then immediately thereafter, Conrad and Adam are considered or deemed to contribute all of the distributed assets and liabilities to a newly formed partnership. And when that happens, that's going to be a complete liquidation of the S corporation, and therefore Conrad and Adam are going to recognize our share of corporate level gain at that point. One of the things we want to point out here in the S corporation context, we've seen this obviously with a number of clients at this point. Be watchful of the section 1239 issue, which deals with related sales of assets to a related party. And we'll talk about this a little bit more because this might require a little bit more planning. But the idea here is if Conrad and Adam are related, this sale or this conversion might be recharacterized, and Conrad and Adam would then recognize the corporate level gain using ordinary income rates instead of capital gains rates. So we'll talk about kind of how to avoid that issue. So that's just a simple conversion process. Another context that we see is the leverage distribution in the S corporation context. So when you make distributions to shareholders in excess of basis, that triggers gain. And so here's, something typically that we see. So Conrad and Adam, again, 50-50 owners of the S corporation. We go out, we go to a third party, we obtain a loan in the S corporation. And when you obtain the loan, there's no gain or loss that's recognized on that. But one thing to keep in mind in the SCorp context, me and Conrad don't get credit to our stock basis on the non-recourse loan that we obtained in the SCorp, okay? We get debt basis, we don't get stock basis. That's important to keep that in mind. then it's just like the partnership context. And the S corporation makes a distribution of the loan proceeds to us. And then, this second step is really an opportunity for us to, provide collateral to the lender, to the third party lender, so that they will be willing to make this loan. Once they distribute the loan proceeds, we will recognize gain immediately to the extent that distribution has exceeded our basis. And because the loan proceeds don't count in our stock basis, that distribution in most cases will trigger gain. And that gain is going to be considered a long-term capital gain if we, held our S corporation stock for a year. And keep in mind that, other rules, the rules that we're going to talk about next, apply in this context as well. Some of the issues and risks that we're really trying to hammer home when we talk to clients about this. Again, this is
can I interrupt real quick? One of the things for all of you to give this context of what we're covering in the prior slides is you got a transaction that's going to close and you don't think you can get it done in 2021, and you look at 2022. If you look at a pattern that Adam and I put together, and what we're seeing, not just us, but what we've seen from Big Four and other law firms, you're either saying, can you go get a leverage distribution and take that money out? And it's either going to cause in the LLC negative capital counts, or in the S-Corp context, a distribution in excess of basis. And also the business decision about your installment sale, whether you accelerate it or not. But by using the check the box rules, what we're trying to do is elongate the period that you can actually try and make the decision, right? So a lot of the check the box rules, you can actually have until March 15th to go do the check the box rules and come back, so that at that point, where's my deal at? Is there a chance that it might not close, and you might not want to do that? So there's some business reasons associated with what we're doing, and the risk is ultimately with the business owners of whether they close or don't close. And I think the other context we're getting this to provide it is earlier deals that we closed in 2020 or 2021, when the folks got rollover equity, they're now looking at it and said, well, maybe I should have recognized that gain, or can I recognize that gain now? Because I have a bunch of cash that I got from my sale, and I'm really worried about paying extra tax. Again, not a financial planner, don't really know the economics associated with that, but I think that's the context for all this acceleration and the questions we're getting. And with that, Adam, you can go to likely one of the most important things we're seeing with small business and related members.
Right, and that's this 1239 issue that we want to make sure we point everybody to. And this kind of feeds off of the context that Conrad just explained, where somebody had rollover equity and they sold their business in 20 or 2021, and they're sitting on some cash and they want to try and recognize whatever built-in gain is remaining on their rollover equity. This is where you got to be careful of the 1239 issue. And that 1239 issue basically says that a sale of assets to a related party, the IRS is going to, that is subject to ordinary income treatment. So even if Adam and Conrad in our situations prior owned their S-Corp stock for more than a year, if we trigger gain and we are related, we will recognize that gain at ordinary income tax rates. Again, that nullifies whatever planning you're trying to accomplish by, accelerating your gain. Here's one of the places where we need to be careful. In a revenue ruling in 1972, the IRS basically treated a situation where a sale of assets a sale of partnership interests to a related party was considered basically a sale of assets by the IRS. And again, 1239 applies to a sale of assets, not to a sale of equity. So in this context, the IRS was able to say, you didn't sell interests, even though that's what the form of the transaction was. You really sold assets. And therefore, because the buyer was a related party, Section 1239 is going to step in and say, the gain that you recognize is not at long-term capital gains. It's going to be at ordinary income rates. So this is kind of a unique position. Conrad and I have gotten to the point where we've done a lot of research on this. And there's not a consensus that the revenue ruling that the IRS may rely on is something that they would rely on in 2021, but it also is something that may not be applicable or may be superseded by additional guidance from the IRS. One of the things I wanted to point out in one of the previous deals was this. Basically, when we talked about in the LLC context, when we're doing the leverage distribution, you'll recall that I had Conrad contribute 98% of his stock in his real estate company to his holding company. And that is effectively because, think about it this way, when the holding company is converted to an S corporation, that means that the lower tier entity, the real estate company, would then turn into a partnership. And again, we're not, and what that does is sort of, we kind of carved out this idea of trying to work our way around this revenue ruling 72-172, where we're not selling, all of the interests. We're only selling a portion of it, right? So in this context, in the context of the LLC, Conrad would be considered as selling, 98% of it and not 100%. Therefore, you might undermine the argument from the IRS that what you're really selling is assets, not interests. So that's one of the reasons why we designed it that way. To kind of refute the IRS treatment in Revenue Ruling 72-172, I think a lot of people look at the context of Revenue Ruling 99-6. And in that context, basically the IRS took the position, remember 99-6 came out after 72-172, and the IRS took the position that when you sell assets, or excuse me, when you sell interests from a partnership to a DE, you basically sold all of your interest. It's treated as an interest sale from the seller's standpoint and an asset sale from the purchaser's standpoint. And so a lot of practitioners have looked at that and said, look, you can't basically be a cherry picker here and say in one context, you're selling interests, in one context you're selling assets, even though basically the form of the transaction is largely similar. So a lot of people have taken the position that because of that inconsistent position, taxpayers have a position to, enter into what's a related party equity interest sale. Like we kind of said at the outset, ultimately this is a risk, and there's no assurance that the IRS isn't going to attack something like that, especially when you're, trying to accelerate capital gains treatment. A couple of things to keep in mind as we kind of get ready to close up here. Even if 1239 applies, it's possible that, if gain is imputed at ordinary income rates, you still can use the QBI deduction to reduce the level of gain that has to be recognized by the client. So just keep that in mind when you're running your models, that if something were to happen, the IRS did attack it, they did impose ordinary income tax rates, that can still be reduced by, whatever QBI offsets there are. And then just keep in mind, as with all transactions that we do all the time, there's other judicially created doctrines, step transaction form, all of these can still apply in this context, given the IRS the tools they need to attack these types of transactions.
I think one of the things on the judicially created doctrines is, for some of these, do you need a business purpose to create any of these entities to mitigate your taxes? And, good tax planning is permitted. And I also would note that, while 1239 is out there, this is really, if you can get comfortable with that position, it's just a business risk that you think that you can close in the next year. We've left ourselves a few minutes for questions, and I'm going to go through a couple of questions or comments we've received, and if I can get Farhad on, he can answer some of the other ones that are there. But a couple of questions, comments we got was, yeah, there is a proposal, so everyone knows, in the proposed legislation, that if you have an SCorp that was formed pre-check the box, you get a 2-year period to actually convert it to a partnership or LLC if you wanted, without paying taxes. And it's in the House Ways and Means Committee. I don't understand the policy. I think it's just a big lobbying group and someone's going to get the benefit. But that is, if you have a list of clients and this goes through, it is something to look out for. You know, there's a lot of clients that had the old bunch of real estate in an SCorp and you can't get out of it. Now's maybe an opportunity. There's also a comment on installment sales and what happens if you receive payments after 9/13. What do you think the taxation is? You know, candidly, if the binding agreement or carve out applies to a sale, what do you do with the installment obligation receipt? We've heard nothing or seen, I haven't seen or read anything about that. I mean, I could see how they could argue both ways, but if the policy is to increase revenue, I think you're just going to tax it at the increased rate. Maybe that's my pessimistic side. And I think, Farhad, there were several questions or comments with respect to yours, and if you want to knock those out right now.
Sure. So one of the questions was just on that ordering rule, and that I talked about how folks use their state and gift tax exemption, and whether or not that's a new interpretation, or has that always been the case? And I think it has always been the case, and it really goes back to historical, because the state and gift tax rates are actually graduated. So there is a state and gift tax for the first like $50,000 of gifts, and it would gradually go up. I think when I first started practicing law in 1992, the estate tax exemption amount was $600,000, and the tax on that first $600,000 was, I think, maybe 37%, and then it went to 39% at $750,000. And so really the idea is that you use up your exemption as the higher you move up, the higher the tax rate becomes. We have since moved to just a flat tax rate of, it used to be in some cases 45%, now it's 40%. But that's how it's always been. That it's not really any change. Another question is, thoughts on termination of grantor trust status in 2021. And, I have a number of clients where, for example, we completed sales to grantor trusts, a number of years ago. So we sold S Corporation stock to a grantor trust, took back a note. The note has been paid off. The spouse continues to be a beneficiary. And we're looking at whether or not it makes sense to go ahead and turn off the grantor trust status of the trust now, just recognizing, mission accomplished, we did what we wanted to do. In order to do that, in this instance, because the spouse is a beneficiary, we would have to make it a non-grantor trust that would require some modification through probably a decanting. And then the trust would likely going forward be considered an electing small business trust, would have to make the election. And, I think that's something that we're certainly considering. I think as I talk about the effective date provisions, one thing I worry about is just a modification and whether or not they would dial it back to a date prior to the date of enactment. So, I think we're waiting to see that maybe the next draft of legislation, see what they're thinking, and perhaps go from there. But I think it is a planning move that clients should consider. In some cases, turning off grantor trust status may not make sense, just because you're in a situation where you have, negative capital accounts, those kinds of things that Conrad and Adam talked about. So it may not be an option. Another question is, and maybe this is a question that I'll answer, and I'll kick it out to Conrad and Adam for them to give their prognostication, but is how likely do you think these changes will pass? And I would say right now, I'm following the legislation and the news reports very carefully, and just looking at what's happening. I think the Senate or the House may take up the infrastructure bill today. There's a tension between the infrastructure bill and the reconciliation bill. And the progressive part of the party says that they won't vote on the on the infrastructure bill until they have an agreement on the reconciliation bill. And the more moderate part of the party, the Democratic Party, is saying we're not going to agree to this much spending, and we want to get the infrastructure bill done. So it's a little bit of a stalemate between the two. Senator Joe Manchin from West Virginia has said that the price tag on the bill is way too high. The $3.5 trillion part of the bill is just way too high. I think I read something this morning saying he might be able to go along with $1.5 trillion. But I would say from my perspective, they're going to need to reduce really the spending side of that. And frankly, they're going to be looking for every nickel that they can raise. These are, these provisions are all revenue raisers. So unfortunately, I don't see a lot of this changing because they're going to need to raise the revenue to narrow the gap to be able to appease somebody like Joe Manchin. And then there's just a question of whether or not, will there be a delay in getting this done? I think the reports I read this morning, there's some concern that this may not get done until maybe December. And, with the 2022 elections coming up, I think a lot of, Democrats in conservative districts are concerned about signing on to something like this coming into an election year. And so it's hard to say. I have no idea. But we're carefully watching it. I'm curious, Conrad and Adam, your perspective on things.
All the information we're getting from the various outlets that we subscribe to, I think there's going to be a change and it's going to be an increase. The question is how significant and what do they carve out? There's some retroactive things in here that I think are kind of unfair, like the capital gains, and do they push that out? Also, if you had conservation easements, they really trying to go back in that statute and actually hammer you if you're a syndicated. They just want to make it a per se rule. And they're also going to limit your deduction going forward times 2 times your basis. And I think it carves out liability. So I think there'll be rate changes. I think that all of us are going to be permanently employed as usual, and it's going to make people unhappy with the uncertainty. But I just don't know when it's going to pass and to what extent. And in between, it's giving a lot of heartburn to the various business people that we have that are looking at this and trying to make business decisions on selling. So I think 12/31 will be a rush to get everything done. And it's going to be an interesting year. That's what I'm saying. Adam, do you have anything further?
Oh, I think you guys both covered it. I think that's, the inertia that's going on right now. I think that we're heading for some change for sure. It's just a matter of when and how much. So
sure. So I'd like to thank all of you for participating and taking time out of your day today. As Farhad indicated, you will be getting the CPE forms, and we'll follow up as this legislation keeps progressing. We'll follow up and have other programs like this to try and keep everybody apprised of what's going on. So with that, thank you very much.
Thanks, Conrad. And as previously noted, please look for an email from Williams Mullen this afternoon with a link to the presentation slides as well as attendance certificates for CPE. Thanks for joining us today and stay safe. Thank you.